Good morning, everybody. And you've been given a very strict schedule to adhere to. So I'm going to kind of run through my presentation because I would at least like you to be aware of the issues. Probably we wouldn't have time to do a deep dive. That could be for another time altogether. But what I intend to cover in the next hour is the amendments to the capital gains provisions in the three major treaties impacting India: Mauritius, Singapore, and Cyprus. So it was the Greek philosopher Heraclitus who said change is the only constant, and nothing signifies change more than the Income Tax Act. It changes every year, now it changes every month, every day, and sometimes it changes hourly. So next time you want to advise a client, I always first go on the web and check, is there some new amendment? Otherwise client will come with Google and say, look, you're giving me something wrong. So it's going on a real-time basis, amendments are taking place. So here, what I intend to cover is, as I said, Mauritius, Cyprus, and Singapore. Look at the capital gains amendments and look at the LOB, that is the limitation of benefit clauses which have been inserted in Mauritius and Singapore, surprisingly not in Cyprus, and little bit time on their interplay with GAR. I understand we have a session dedicated to GAR, but I'd just like to bring out the amendments and the interplay with GAR, and of course leave it to Mr. Sridharan to take it in a deeper session. So first, before we go forward, let's look at the background, because unless you have a context, everything is an abstract. So let's look at where we were and where we are going to, or where we are now. A typical investment scenario, and this has been true for most investments in India, is that you have an Indian investee company which is floated by the Indian promoters, and you have a foreign investor who comes in, because obviously we're looking only at foreign investors, that's why it's relevant. Now if he comes in through his normal country of jurisdiction, which could be America or it could be Western Europe, he does not get the benefits of any concessional tax treaty in India. Capital gains he ends up paying in India, and he gets a credit for the taxes paid in India against the tax which he has to pay in his country. So he decides, why not I look at something innovative and come through a tax haven, an intermediate holding company, which could be one of the popular four jurisdictions, the fantastic four. So we have Mauritius, Singapore, Cyprus, and Holland or Netherlands. These are the four favorites which people generally would consider to come into India. If you look at the top 10 FDI jurisdictions in India, the foreign direct investment jurisdictions over a period of 16 years, from 2000 to 2016, Mauritius, no surprises, tops the list at 33% of all FDI, followed by Singapore at 16%, and then other jurisdictions. So if you add our top three, Mauritius, Singapore, and Cyprus, which have been amended, they account for $168 billion of FDI, or 52% of all FDI within the 16-year period. And that is quite a significant, and Mauritius alone is 108 billion. So that's a very large quantum which has been coming through this. In fact, a saying goes that the Mauritius economy is totally dependent upon Indian FDI. You plug this, I don't know what they're going to do next other than beach surfing and coconut drinking. So this is the importance which India has for these countries. Now, jog back to another 6-7 years, and we had a series of Supreme Court and High Court decisions which very clearly said treaty shopping is valid and legal. No harm, you want to come via Mauritius, please come. You can incorporate an IHC, an intermediate holding company, in a tax-friendly jurisdiction. It is the legal and the beneficial owner of the shares. You don't need to look who's behind the IHC. So if supposing an American company sets up an IHC in Mauritius and then invests in India, you don't need to see that the ultimate owner is the American company. It is fine. It would be treated as if the Mauritian company has sold the shares, and that would be enough to claim capital gains exemption under the treaty. No tax in India if the treaty so provides, and none of these jurisdictions levy capital gains in their local jurisdictions. So net, you go tax-free all throughout. Series of favorable decisions like Azadi Bachao Andolan, which was the first decision, Supreme Court, followed by Vodafone International, again Supreme Court, and the Andhra Pradesh High Court in Sanofi Pasteur. What they also said, that obtaining a tax residency certificate under section 90 subsection 4, read with rule 21AB, is enough to claim treaty benefits. So there was a lot of back and forth in 2011 to 2012 on what do you need to have to claim treaty benefits. Ultimately, the law as it has evolved says that a TRC from the local jurisdictions, if you're a Mauritian company or a Cypriot company, a TRC from that jurisdiction is enough to claim tax benefits. And again, you have many Supreme Court, High Court decisions, even the CBDT Circular 789, which was the first judicial pronouncement from the government, which said that TRC is sufficient to claim tax benefits. Again, Vodafone said in absence of a limitation of benefit clause in the treaty, a TRC is sufficient. So it kind of gave a caveat. Again, if you look at the advance authority ruling in Dynamic India, it said because there is no GAR currently in India, at that time there was no GAR, a treaty benefit can be claimed on the basis of a TRC. And we even have the Bombay High Court in universal bearing, which has said that treaty benefits can be claimed on the basis of a TRC. So this is the background within which the government was trying to renegotiate the treaties. And as I said, the four hotspots were these. 59% of FDI from these four put together over 16 years. Government trying very hard to renegotiate tax treaties for all these four jurisdictions. So this is where we were. Now where are we? Look at the comprehensive treaty network of India. India has 94 comprehensive double tax avoidance agreements. It has a limited agreement with some jurisdictions. It has a tax information exchange agreement with some jurisdictions. But it has 94 comprehensive DTAAs with various countries across the world. Of these, under 10, and this I'm talking prior to the amendments, capital gains was levied in the country of residence. So these are the ones which are pain points for India, because here tax is levied in their jurisdiction, not in India, and therefore India does not get a share of the pie. 84 taxes levied in India, India is very happy. Let's first look at the 84. Of the 84, 4 have a 10% condition. So only if 10% of shares in an Indian company are sold will India get the right to levy capital gains, otherwise it is in the foreign jurisdiction. Other 80 have no condition like this. In all 80 cases, India gets the right to levy capital gains. These 4 out of these 84 do not have a limitation of benefit clause, and therefore GAR will definitely apply to these coming forth from next month. Of the 80, 38 jurisdictions have a limitation of benefit clause, and hence whether GAR will apply, that's an interplay question which needs to be looked on a case-by-case basis. 42 do not have a limitation of benefit clause of these 80, and hence GAR will definitely apply there. Coming to the 10, where there is a country of residence capital gains, 4 are the IHC hotspots, Mauritius, Singapore, Cyprus, Netherlands, which we will be looking at in detail. 6 are other nations which again do not have a limitation of benefit clause, and hence GAR will apply. Of these 4 going forward, 2 will have an LOB and 2 will not have an LOB. So this branch decision matrix table will show you how India's treaty network pans out when it comes to capital gains. Which are the 4 out of the 84 where India can levy capital gains only if 10% or more stake is sold? Belgium, France, Spain and Denmark. Only if they are selling more than or equal to 10% of the stake of an Indian company, then India gets the right to levy capital gains. Otherwise, the capital gains is levied by Belgium, France, Spain and Denmark. Going forth, would they become interesting destinations for IHC? Could be. If you are going to end up owning less than 10%, and more so if you are a foreign portfolio investor. So if you are an FPI or an FII, under the SEBI regulations, you can own only up to 10% of an Indian company. So if I am an FPI, why not I set up shop in Belgium? Why not I look at Spain? Why not I look at France? Because anyways I am owning less than 10%. I come via these countries, I get benefit of the capital gains treaty. I don't pay tax in India, I pay tax only in my country of residence. That's something which could happen going forward. And we've already started seeing inquiries in the minds of FPIs whether they should migrate to such jurisdictions. Of the 10, 6 countries where there is no capital gains in India, only in the country of residence. These are Jordan, Kenya, Philippines, Portugal, Sweden and Zambia. The treaties of Jordan and Sweden have an additional requirement that they would be levied in that country only if Jordan and Sweden levy capital gains. None of them have a limitation of benefit clause in the current treaty. Of course, it remains to be seen whether India renegotiates, and GAR will apply. In 3 cases, there is capital gains in the local jurisdiction, that is Jordan, Philippines and Portugal, but Kenya, Sweden and Zambia do not levy capital gains. There was a 7th country, South Korea, which very recently did not remain on this list because the capital gains has been changed to country of source from country of residence. So from 7, list is now pruned to 6. So coming to Mauritius, our favorite of the government, which they have been trying to amend for the last 15 odd years, and there have been several Supreme Court, High Court decisions. Now finally, there has been an amendment. So the protocol came into force with effect from 19 July 2016. It now provides that earlier what used to happen, that gains by a Mauritian resident from alienation of shares in an Indian company would be taxable only in Mauritius. That's a residence-based capital gains. Now the residence-based taxation is being done away in 3 phases. Phase 1, gain from alienation of shares acquired on or before 1st April 2017 would continue to be taxable only in Mauritius. So irrespective of whenever sold, if they have been acquired prior to 1st April 2017, so you have about 25 days to buy shares if you want, then they will continue to be taxed in Mauritius. Nothing under the treaty, nothing will change, only capital gains in Mauritius, which is 0, therefore no capital gains at all. Phase 2, this is interesting. Capital gains from alienation of shares acquired after or on 1st April 2017 and sold between 1st April 2017 and 31st March 2019. So a 2-year transitional window. If you buy and sell within this window, then they are taxable in India, but at 50% of the capital gains rate leviable. So if it's long-term capital gains and the rate is 20% on unlisted shares, only 10% would be levied under the transitional window. So it's gradually ramping up. Rather than giving you shock treatment, it's giving you slow poison. Third phase, once the transition is over, you are back to normal at par with an Indian resident. So gain from alienation of shares acquired after 1st April and sold anytime on or after 1st April 2019 would be taxable in India at full capital gains rate. So looking at our example of unlisted shares, 20% if sold on or after 1st April 2019. It applies to shares being alienated. What is the meaning of shares? That has not been defined in the treaty. So you go by the generic definition, it would include equity shares, compulsorily convertible preference shares. Currently, foreign investors are not allowed redeemable preference shares, optionally convertible preference shares under the FEMA regulations because they are treated as debt. If they are invested or if they are allowed, they would also be covered. Capital gains for alienation of any other property continues on residence-based taxation. So any other property like compulsorily convertible debentures, if they are alienated, they would continue to be taxed in Mauritius like before. No change in the tax treatment for that. Whenever sold, whenever bought, continue to be taxed only in Mauritius. So if you look at this diagram, so you have the purple block, which is 1st April 2017, the main date. Anything acquired before that, no capital gains in India. That's what the maroon arrow shows. Anything acquired between the purple and the orange block, that is 1st April and 31st March, and sold between this block, taxable in India at 50% capital gains, plus there is a limitation of benefit clause. Interestingly, no limitation of benefit clause for the first block, limitation of benefit for the second block, and anything sold after the orange block, that is acquired after 1st April and sold after 31st March, that would be taxed in India at full capital gains rate. Here obviously you don't need a limitation of benefit because you are paying full tax in India. Where is the benefit? So this timeline shows you the milestones as to when you buy, when you sell, and what you pay. As I mentioned, sale of compulsorily convertible preference shares, they would be taxable according to the phase-wise taxation which we looked at. If they are acquired prior to 1st April 2017 and sold as such, the grandfathering provisions would apply and there would be no capital gains in India and it would be exempt under the treaty. But what if the CCPS are acquired prior to April 2017? They are converted into equity shares after 1st April 2017 and then what is sold is the equity share. Would the grandfathering provisions yet be applicable? That's something on which there is no clarity. Recently, the Finance Bill 2017 has come out with an amendment that any conversion of CCPS into equity will not be treated as a taxable transfer under section 47 and will be treated as the period of holding and cost of acquisition was same as that of the CCPS. So it tends to apply that therefore it should be available if acquired and converted after 1st April 2017. But we are looking at a case where the conversion takes place today. In such a case, there is no beneficial provision in the Income Tax Act. On the contrary, there is a judicial controversy as to whether or not conversion of CCPS into equity is a taxable transfer. The Andhra Pradesh High Court in Nizam's estate has taken a view that a conversion of preference into equity is a taxable transfer leviable to capital gains. But the Allahabad High Court in Goel Investment Limited and the Mumbai Tribunal in an old decision of Vijay Merchant and the circular of the Department of Revenue of 1958 all tend to say, give an impression and tend to signify that conversion does not give rise to capital gains. Hence, I believe there is a good merit in saying that conversion prior to 1st April and sale of the equity is a reasonable case to say that it should not give rise to capital gains and the grandfathering provisions should apply even then. But no clarity, and this is something on which you should be prepared for litigation because the department would like to come hard, more so in the light of the amendment after 1st April. What happens in the case of CCDs? So just as we saw preference being converted into equity, what about compulsorily debt being converted into equity? Under FEMA, investment in CCD is treated as part of equity capital. So if somebody has invested in the CCDs and it wants to convert them into equity prior to 1st April and sell the equity shares after 1st April, would the grandfathering provisions be applied? Here the position is a slightly better one. The Income Tax Act currently also provides under section 47 that conversion of CCD into equity is not treated as a taxable transfer. Hence, a view can be taken that the grandfathering should be available. But there is a Calcutta High Court decision in Mrs. A. Ghosh which says that even though the benefit of taxable transfer is available, the date of acquisition of the equity is the date of acquisition of the equity shares, not the original CCD. So you ignore that you were already holding a CCD. As opposed to that, last year there was a decision of the Punjab and Haryana High Court in Naveen Bhatia, where the Punjab and Haryana High Court distinguished Mrs. Ghosh's decision by saying that if there was an inbuilt inherent conversion clause, which is the case in a CCD, you should look at the date of acquisition as the date of the CCD, whereas in Ghosh's case, the debentures were modified to include a conversion clause. To set right the controversy, last year CBDT even came out with a Rule 8A, which now provides that in case of CCDs, the date of acquisition is the date of the CCD and not the date of the equity shares. Looking at all of this, I believe it's a very strong case to say grandfathering provisions should apply and the date on which you acquired the CCD would be treated as the date of acquisition of the equity shares. Better position than CCPS, more so because of Rule 8A and the Punjab and Haryana High Court decision. So if you look at a table of before and after, so just as you have weight loss programs which show you before and after, here I am showing you what is the weight loss or the weight gain which is going to take place because of the protocol. Equity shares in an Indian company, before taxable in Mauritius, now taxable in India in 3 phases. Compulsorily convertible shares sold as such, preference shares, earlier taxable in Mauritius, now taxable in India in a phased manner. CCDs sold as such, taxable in Mauritius, continue to remain taxable in Mauritius. Here there is no question of whether or not, there is no doubt because what you are selling is debt, not shares. Derivatives, taxable in Mauritius, continue to remain taxable in Mauritius. The question marks at the right column continue for preference shares and debentures which are converted and sold after conversion. Would grandfathering be available? That's what we just discussed in the past 2 slides. I believe they should be available. Now Mauritius has also come out with a limitation of benefit clause. Now all this talk of giving benefit also means they want to take back benefit. So it's a very simple, what the right hand giveth, the left hand taketh back. That's the policy on which the government would like to operate. So they came out with a limitation of benefit clause in Article 27A. It says a resident of Mauritius, and we are looking at it only as a Mauritius selling in India. Converse is also true, but we are more interested in a Mauritian resident selling in India. A Mauritian resident cannot take benefit of Article 13.3b of the treaty. Very specific, only 13.3b. if the primary purpose is to take advantage of benefit in Article 13.3b. Now what is Article 13.3b? The second phase of taxation, that is 50% capital gains for shares acquired after 1st April 17 and sold before 31st March 2019. Only for this second phase there is an LOB, and not for the first phase where you get total tax exemption, that is 13.3a. For grandfather provisions, there is no limitation of benefit. Now this is a very interesting bargain which Mauritius was able to negotiate as opposed to Singapore. When we come to the Singapore Treaty, you will see that LOB applies to both A and B, whereas Mauritius said nothing doing, only for B. A, there is no LOB. Then they define a shell or a conduit Mauritian company is not entitled to the benefits of Article 13.3b. And what is a shell or a conduit company? Any legal entity, so it can be any legal entity which is a resident of Mauritius under Article 1 of the treaty, and it has negligible or nil business operations or no real or continuous business in Mauritius. So negligible, nil, no real, no continuous business operations in Mauritius would make it a shell or a conduit company. Then what is not a shell or a conduit company? So they have given even a positive and a negative. So if you fulfill these conditions, you are not a shell or a conduit company. If expenditure on operations in Mauritius exceeds Mauritian rupee or equals to rupees 15 lakhs in the immediately preceding period of 12 months from the date in which the capital gains arise. So if the capital gains is arising in April, 12 months prior to that, you should have spent a total of rupees 15 lakhs Mauritian rupees on operations in Mauritius. And converse, you are not deemed shell company if you have not spent, or if you have, even if you are listed on a recognized stock exchange in Mauritius, but you have not spent 15 lakhs, yet you would not be treated as a conduit or a shell company. What is expenditure on operations? Again, this is something which has not been defined under the treaty, but expenditure on infrastructure, on salary, on personnel, on staff, manpower, having a reasonable office size, carrying out any operations of business, all of these would be expenditure on operations which you need to spend in Mauritius within a period of 12 months, in which case you would be eligible for the 50% concessional capital gains. You would be treated as if you are not a deemed or a shell company, and hence the limitation of benefit clause under 27A would not apply to such a Mauritian company when it alienates the shares from Indian company. Some decisions on the Mauritian treaty which have recently been delivered, I am just covering them because they are also quite interesting and relevant. One is of Serco BPA versus AAR, Punjab and Haryana High Court. Here a Mauritian private equity fund, or rather a private equity fund located in Mauritius, Blackstone and Barclays, were exiting from a BPO. The department and the AAR held that prima facie it's a colorable device and hence tax should be deducted on the gains made by them even though they are based in Mauritius, and treaty benefit should not be given. The department's pleas were very interesting. The real beneficiaries don't reside in Mauritius, so a company is supposed to actually reside in Mauritius. I don't know how it would be possible. Sellers don't carry on business, manufacturing, don't provide services in Mauritius. They claim to be residents only on the basis of TRC, and this is a clear case of treaty shopping. Now this is after all the judgments which we saw of Azadi Bachao, Vodafone, and Sanofi Pasteur. This is what the department said. The Punjab and Haryana High Court negated all pleas and said there is no material to show tax evasion. All documents asked were provided. TRC is valid. They looked at Azadi Bachao, and they also looked at the articles of the treaty. This was prior to amendment. 13.4 applies to other property and it is taxable only in Mauritius. It is not dependent upon situs of property. It looked at other articles 1, 2 and 3 of 13 where it is dependent on the situs like immovable property, permanent establishment and ships and planes. There is no such provision in the case of shares, hence tax is only in Mauritius. If there is no tax in India, there is no liability to deduct tax under 195 and buyer is absolved from all penalty. Now you would have to see whether there is a phased manner of taxation under the 3 phases we looked at. Again, a Mumbai Tribunal decision in Goldman Sachs on the same lines where treaty benefit is available, no requirement to deduct tax at source in India under 195. Only if there is capital gains would you look at TDS. You compare this decision with the Madras High Court's decision in T. Rajkumar, which was given under the context of the Indo-Cyprus DTA, which we'll deal with next, where the Madras High Court ignored the treaty and said, yet you have to deduct tax on the sale consideration, not on the capital gains component. So next, let's go on to the Cyprus DTA. This has had a very checkered history. Cyprus has been one of the black sheep, not just from an Indian perspective, but also from the international perspective. OECD a few years ago declared Cyprus as a tax non-compliant jurisdiction, and India also has declared it as a notified jurisdiction. So it has a very checkered history, which it is now trying to set right. Section 94A of the Indian Income Tax Act provides that the government can notify any area as a notified jurisdictional area, and Cyprus was notified on November 2013. The consequences of this were that no deduction was available to an Indian company for any payment to an FI based in Cyprus unless authorization is furnished by the FI in Form 10FC. No deduction for any payment to any Cypriot payment person unless specified documents for 8 years are maintained. And the most dangerous one was TDS at 30% or rate prescribed in the Act, whichever is higher, applied to any payment made to a Cypriot company. Now the question arises, do you deduct tax on the gain component only, or do you deduct tax on the sale consideration, ignoring the gain? We've had several decisions, including that of the Supreme Court in General Electric Technology Center, where the Supreme Court said 195 withholding liability only arises on the capital gains component or the gain component. If there is income, you deduct tax. Again, the CBDT has issued a circular to that, looking at the Madras High Court decision and a negative Madras High Court decision and the Supreme Court's decision, saying to the effect, not so clearly, that 195 liability is only on the income component. Here, the matter went in Rajkumar's case to the Madras High Court. So it was a real estate company where the promoters had the equity and CCDs were owned by a Cypriot company. The real estate company made a huge loss, and the time came for giving an exit to the Cypriot company. The promoters bought out the CCDs at a loss, so the Cypriot company actually made a loss. It invested 100, sold it for 80. Anyhow, even if it would have made a gain, it would have been exempt under the treaty. The income tax officer said, why did you not deduct tax at 30% on the 100 rupees which you paid the Cypriot company? They said it's exempt under the treaty, and anyhow there is a loss. Where is the question of deducting tax at source? Madras High Court said the petitioners, that is the Indian promoters, should have deducted tax at source and thereafter fought a legal battle with the department for refund. So they ignored the Supreme Court decision, they ignored the treaty, they ignored the CBDT circular and said you should have deducted tax on 100 at 30% and then claimed a refund. Similarly, several other cases involving Cyprus, there was this issue of whether to deduct tax at source when you are giving an exit. Practical position was deduct and fight. So this was becoming a big roadblock while dealing with Cyprus-based entities. Then came the protocol to the DTA of the Indo-Cyprus Treaty, notified on 10th January 2017. So only recently it was notified. Again, same like Mauritius, residence-based taxation is shifting to source-based taxation in two phases, sorry. After 1st April, whatever shares have been acquired prior to 1st April will be taxable only in Cyprus. That should have been taxable only in Cyprus. So grandfathering provisions are applicable. Old investments made prior to 1st April would be taxed only in Cyprus. New investments would be taxable only in India. No 50% transitional rate like we saw in Mauritius. So like we had 1, 2 and 3. 2 is missing here. Directly 1 and after that you go to 3 full capital gains in Cyprus. Sale date not relevant in the case of grandfathered investment. Would interest be taxable at 7.5% like Mauritius? Now Mauritius also got one extra bargain. The Mauritius treaty now provides that any interest paid to a Mauritian resident by an Indian company would be taxable at 7.5%. This is the lowest tax rate under all treaties compared to Cyprus and Singapore. Cyprus earlier was the lowest at 10%, and that is why if you see most real estate companies had equity coming in from Mauritius, real estate CCDs coming in from Cyprus, on which interest was paid and they were claiming a deduction at 30% here, paying tax at 10% there. No thin capitalization earlier 94B, and it was a win-win for everybody. Now 10% continues to remain at 10, but Mauritius has come out at 7.5. Singapore is yet at 15. So Mauritius is the cheapest interest rate on CCDs, and that's an added advantage. There is one more clarification added, which I don't know why it has been added, but it's only added in the Cyprus Treaty. Dividends will not be taxable in India. There will be no TDS in India till such time as India continues to levy dividend distribution tax, and dividends continue to remain exempt from tax under 1034 in India. So till such time as India does not levy tax on dividends in the hands of the recipient, there will be no tax on the Cyprus company. This is the position even today, and this has been a clarificatory amendment which is added to the treaty. Surprisingly, no limitation of benefit clause in the Cyprus protocol. This is something which is quite difficult to understand, how Cyprus did not get an LOB clause. It is there in Mauritius, it is there in Singapore, but it is not there in Cyprus. No minimum spending threshold at all under the limitation of benefit. No concept of a shell or a conduit company like there is in the other treaties. Several Indian DTAAs have been amended to insert an LOB clause. Currently we have 40 limitation of benefit clauses, but not so in the case of Cyprus. Only GAR would now apply in the case of these treaties where there is no limitation of benefit clause. So this has been one surprise amendment which has been left out, knowingly, unknowingly, I don't know, but which is not there in the protocol to the Indo-Cyprus Treaty. We looked at notification 86 of 2013, which notified Cyprus as a non-cooperative territorial jurisdiction, meaning what we looked at, that you have to deduct tax at 30% or higher, whichever is the higher rate. This was rescinded by the Indian government with effect from 14 December 2016, which said that now this non-cooperative notification has been rescinded, except things done or not done before such rescission. Now, it was worded in quite an interesting manner. What happens to TDS litigation, like in Rajkumar's case, which has been going on? Because this says that even though the notification is rescinded, anything done, that is TDS dispute, or not done, that is not deducting TDS, on the basis of this will continue as before. And Rajkumar's case also went to the Supreme Court by way of a special leave petition, where the Supreme Court, after considering the 14 December notification, dismissed the case saying appellant, that is the promoters, are covered by the rescinding notification of 14 December and hence it can take advantage of it. Supreme Court is saying take advantage of it. CBDT notification is saying you can take advantage of everything other than that which is done or not done. How do I reconcile the two? Would the Supreme Court order which says I can take advantage override the notification? I think there is a good case for saying that the Supreme Court order, being supreme, would override a CBDT notification, and you may have a good case to claim. But again, you should be ready for drawn out litigation, because department would obviously say that look at the notification, it says except things done or not done, hence I'm not going to give you a refund of the tax which you have deducted, and you keep litigating. So this is something again which is not as clear and as happily worded as it should have been. Singapore DTAA, which is the third in the Troika, Mauritius, Cyprus and Singapore. This is the order in which they took place. Signed on 30th December, so this was a New Year gift just before people got drunk. They decided let's do it in good senses, otherwise we'll end up doing something totally wrong. So they did it on 30th December. Interestingly, not yet notified in India. In India, we just have a press release by the CBDT. The Internal Revenue Authority Service of Singapore has gone ahead, released the protocol, and on Monday, that is 27th of February, it was notified and it came into force in the country of Singapore. India has to do it very soon, and likely it would be doing it before 31st March 2017, and from that it will become law in the country of India. Original DTAA of Singapore was amended by a protocol in 2005. That was one of the first cases where a limitation of benefit clause was inserted in very clear terms by the 2005, which said that you need to spend Indian 50 lakh rupees or $2 lakh of Singapore, and in the period of 2 years to get capital gains benefit. So that was done in 2005, and it also came out with a added clause that Singapore will get residence-based taxation till such time as Mauritius gets residence-based taxation. So India said, okay, we'll give you the benefit. Moment we plug Mauritius, we are going to come and plug you. So once Mauritius was plugged, the next focus for the Indian government was the Indo-Singapore Treaty. And naturally, as was earlier agreed in 2005, there was a negotiation, and now they want to move ahead from residence-based taxation to source-based even in Singapore. Here we are back to 3 phases. Mauritius 3 phases, Singapore 3 phases, Cyprus 2. Now, why there is a difference? I think it all depends on the bargaining capacity of each person. Capital gains from alienation of shares acquired prior to 1st April, taxable only in Singapore, irrespective of when and how alienated. So you don't need to look at when sold. As long as they were bought before 1st April 2017, continue to be taxable only in Singapore, same as Mauritius. Back to a second 50% concessional transitional phase. Capital gains from alienation of shares acquired after 1st April 2017 and sold between 1st April and 31st March 2019, taxable in India at half the capital gains rate. So if the tax rate in India is 20, you pay only 10% capital gains in India. And third phase, sold after 31st March 2019, taxable in India at full capital gains rate, whatever it may be. Again, source-based only for shares, alienation of shares, equity preference, compulsorily convertible, redeemable preference, optionally convertible preference shares. Capital gains from the alienation of any other property continues to be taxable only in Singapore. Debentures, compulsorily convertible debentures, derivatives, all will continue to remain taxable only in Singapore, same as is in the case of Mauritius. So the same before and after, equity shares, preference, compulsorily convertible debentures, all the equity shares taxable in Singapore earlier, now they would be taxable in India. Preference shares taxable in India in a phased manner. Compulsorily convertible debentures would be taxable before and after only in Singapore, same for derivatives. And the same issue arises whether grandfathering will be available to sale of equity shares and to sale of equity shares on conversion of debentures if they are sold after 1st April 2017. Limitation of benefit clause here is very interesting and very different from Mauritius. So here we have Article 24A. Now if you just jog your memory back a few slides, we had 27A in the Mauritius protocol, which said limitation of benefit only for benefit under Article 13.3b. When you want the concessional 50%, you have to spend 15 lakh rupees in Mauritius in a period of 12 years. Here there is a 2-phase LOB. It says a Singapore resident cannot take benefit of nil capital gains. So even for shares acquired prior to 1st April 2017, if you want benefit, you cannot take benefit if primary purpose of that is to take advantage of 13.4A, that is the nil capital gains rate. Same, that is the second one, Singapore resident cannot take benefit of 50% capital gains in Article 13.4C of the treaty for shares sold between 1st April 2017 and 31st March if the primary purpose is to take advantage of this article of the treaty. So here both are covered, there only one was covered. Again, shell or a conduit company which claims it is a Singapore resident cannot take benefit of 13.4A and or 13.4C. Shell or a conduit company definition remaining the same, legal entity with negligible, nil, no real, no continuous business in Singapore. Here again, what is not a shell or a conduit, there are different benchmarks. If you want benefit of 13.4A, that is no capital gains for shares prior to 1st April, you need to spend more than Singapore $2 lakh in the immediately preceding period of 24 months from the date in which the capital gains arises. So here in a 2-year window, you need to spend $2 lakh. But if you want the 50% transitional benefit, then you need to spend $2 lakh in the immediately preceding 12 months. So in one case, full exemption, you have a 2-year window. Part exemption, you have a 1-year window. Amount remains the same, Singapore $2 lakh to be spent on operations in Singapore. What is operations? Same as we looked at in Mauritius. Staff, personnel, professionals, infrastructure, salary, equipment, all of that in Singapore, $2 lakh. And incidentally, $2 lakh in Singapore is not that big a sum. So to meet the substance requirements, you are being given a 2-year or a 1-year window depending on the Article 13.4a or 13.4c which you want to follow. Also, if you are listed on Singapore Stock Exchange, SGX, then you don't need to comply with this because you would be treated as if you are not a deemed or a shell conduit company. Then there's an interesting Article 28A, and this is one of the first cases where it has come. Again, not so in Mauritius, obviously because Mauritius is the blue-eyed boy. Not so in Cyprus, which is the black sheep, but so in Singapore, which was in between. I don't know why. You have Article 28A. The TTAA shall not prevent India, and the wordings are very interesting, shall not prevent India from applying its domestic law and measures concerning prevention of tax avoidance or tax evasion. So just to rephrase and read it again, DTAA shall not prevent India from applying its domestic law and measures concerning prevention of tax avoidance or tax evasion. What does this mean? This is in effect giving a carte blanche to GAR to override everything which is there in the treaty. It says that my domestic law can do anything for prevention of tax avoidance or tax evasion, and nothing in the article will prevent me from doing so. Even if I were to comply with the LOP clause under 27A, under 24A, can GAR yet be invoked? Even if I have $2 lakh, even if I'm a listed company on SGX, can GAR yet be invoked? Then why have a limitation of benefit clause at all? This one clause was enough to say that GAR will apply. And this is not there in Mauritius or Cyprus. This is something which, when viewed in conjunction with the CBDT FAQs on GAR, which were released last month, in January, they're quite interesting how this would interplay with the GAR and the limitation of benefit clauses. So let's look at a comparison matrix of these three vis-a-vis the last fantastic four, that is Netherlands, who have yet been left untouched. Shares bought before 1st April 2017, so 25 days to go. No capital gains in Mauritius, no capital gains in India under the Mauritius Treaty whenever sold by a Mauritian company. In case of Singapore, no capital gains in India whenever sold by the Singaporean company. In case of Cyprus, no capital gains in India whenever sold by the Cypriot company. So all three on par. Netherlands we'll look at little separately. Shares bought after 1st April and sold before 31st March 2019, the transitional window. 50% capital gains in India for a Mauritian company, 50% of the capital gains in India for a Singaporean company, full capital gains in India for a Cypriot company. Cypriot was not able to get this benefit as compared to Mauritius and Singapore. Third phase, shares bought after 1st April 2017 and sold after 31st March 2019, full capital gains in Mauritius, Singapore and Cyprus. So all three at par when it comes to that. What about Netherlands? And Netherlands has a very interesting treaty. So capital gains are generally taxable only in Netherlands from alienation of shares made by a Netherlands company, a Dutch company, from shares in an Indian company. But they are taxable in India in two scenarios. If the seller owns 10% or more stake, so if there is an alienation of 10% or more stake, and if the sale is to an Indian resident, then in either of these cases, the capital gains would be taxable in India. However, this exception also, there is an exception. It does not apply if the gains are made in the course of merger, demerger or corporate reorganization, and the buyer or the seller own at least 10% of the capital of the other. So exception to the exception again reverts the capital gains back to Netherlands. Otherwise, it is always taxable in Netherlands. More than 10% or sold to Indian resident, it is taxable in India. But if it is in the course of reorganization, it is taxed only in Netherlands. So therefore, Netherlands yet has an untouched tax treaty. Very likely that Indian government may or may not, I don't know what, but it's likely that they would try and negotiate that also. However, as compared to Mauritius, Singapore and Cyprus, Netherlands doesn't have the tag of being a tax haven. It is more or less a sophisticated jurisdiction of the European Union. Hence, unlikely they would go at it with the same vengeance as they went after these three. Tax on interest is also interesting. Mauritius now cheapest at 7.5%. Singapore most expensive as before at 15%, and domestic tax rate in Singapore is 17%. So you actually end up paying 17% if you repatriate interest back to Singapore. However, if you were to keep it offshore, that is say in Hong Kong or Vietnam, it would not attract the 17%, and Cyprus at 10%, Netherlands at 10%. Now, grandfathering provisions which we looked at, which is same in all three, Mauritius, Singapore and Cyprus. What about some other scenarios of grandfathering? We looked at compulsorily convertible debentures and compulsorily convertible preferential. What if bonus issue of shares is made by the Indian company after April, but original was acquired before April? What if a stock split takes place by the Indian company after April, but original was acquired by the Mauritian company before April? What if the Indian company goes in for a merger or a demerger, and the transferee company in a merger or the resulting company in a demerger issues shares after April, whereas original in the transferor or the demerged company were held prior to April? In such a case, would the grandfathering provisions apply? Would the benefits under the tax treaties be available? No clear answers. I'm giving my 2 cents worth of views on that. Bonus and stock split, the original shares were issued prior to April, and what is now taking place is only a consolidation or a division. Hence, I believe grandfathering should be available even if they are acquired prior to, after 1st April and sold after that. Because in effect, the original share remains that and you are only dividing it or increasing it. But in case of a merger or a demerger, it is a totally new company, the resulting company or the transferee company, which is issuing shares after 1st April. Here could be a challenge to say that the grandfathering provisions should be carried forward even to the new company, and even the new shares should be part of the benefit under the grandfathered provisions. However, no clear-cut views on this. This is just one line of thinking which could be developed or which could be an argument. So this is something where again we'll see a lot more litigation going forward. Is there a clause for indirect transfer under either of these treaties? Now, go back to 2012 when the infamous Vodafone amendment hit the Indian shores. After the Supreme Court's decision in Vodafone, which said indirect transfers, that is, if the holding company's shares are transferred, there would be no capital gains in India because the holding company was located abroad. To overrule that, the Indian government came out with a retrospective amendment dating back to 1961 in explanation to Section 9, saying that in case of indirect transfers, tax would be in India if more than substantial value is derived from the Indian assets. And now we have rules defining what is substantial assets, etc. Would such a case be taxable under the treaties of Mauritius, Singapore, Cyprus and Netherlands? It needs to be looked at that none of these 4 treaties have a clause for taxing capital gains directly or indirectly. If the words are used in a treaty, directly or indirectly will be taxed in India, then yes, indirect transfer will also be covered. Or if the words used are that the jurisdiction may tax it in accordance with its domestic law, which is the case in USA treaty, then it would be taxable in India. South Africa and Israel are 2 treaties where India has a provision for indirect transfer taxation. It says gains arising in India would be taxed in India directly or indirectly. So there is a provision for taxing indirect transfers under these 4 treaties, and UK is also at par with US. If you look at the Andhra Pradesh High Court decision in Sanofi Pasteur, which is a very landmark decision when it comes to indirect transfer, there the Andhra Pradesh High Court has said that this provision of indirect transfer is not applicable to tax treaty countries. So if you are coming from a tax treaty country, then indirect transfer provisions do not apply. This is also what the Finance Minister's speech Finance Minister said in his speech while moving the Finance Bill 2012, the then Finance Minister Mr. Pranab Mukherjee, that it does not apply to countries coming from tax treaties or companies coming from tax treaties. Hence, there's it's quite clear that this would not apply in Mauritius, Singapore, Cyprus or Netherlands because none of them have an indirect transfer provision and all of them are tax treaty countries, hence there should not be any indirect transfer when an Indian company is directly the last beneficiary. So this is what I just mentioned and I've elaborated in detail. So if you juxtapose the Indian Income Tax Act and the DTAA, long-term, and we're looking at unlisted shares. So long-term capital shares bought before 1st April, no tax in either of the 4 jurisdictions. Transitional provision, 50% tax rate in Mauritius and Singapore, so 20% becomes half. 10% tax rate in Mauritius and Singapore companies, 20% for Cyprus, Netherlands, yet provided you comply with the conditions. Shares, short-term capital is bought after 1st April and alienated in the transitional window. So here 40% or 30% if it is a FPI, and that would be the full rate, and you look at for a foreign portfolio investor under section 115 AD, you have a concessional rate of 30% in case of capital gains. Same in the case of Singapore, same in the case of Cyprus, but Netherlands there is no capital gains because of the treaty. There is no capital gains locally in either of the three jurisdictions. Netherlands does not levy provided 5% or more is held in the Indian company. What has been the FDI last year after all these amendments came out? So Mauritius, which always used to be at a high, has tapered down a bit. It is now 36% from April to December. Singapore has improved at 20%. Cyprus, obviously, because till the protocol came out, it was in blacklisted, so it is 2%. And Netherlands has been constant at 7%. Going forth, likely that it may be reversed with Netherlands attracting more FDI. Limitation of benefit clause in India's treaty network. As I mentioned in the treaty chart, India has 40 TTAAs where it has limitation of benefit clause. And there are a variety of types. They are specific quantitative based, rule based. So here there are objective tests which you need to fulfill and you get a limitation of benefit clause. Or there are subjective, which is qualitative, known as the PPT test, the principal purpose test. So when the primary objective is to claim tax benefit, you will not be given tax benefit. This is more subjective and you need to look at it on a case-by-case basis. Out of the 40 treaties which India has in LOB, 11 are a combination of objective LOB plus PPT. These include Mauritius, Singapore, Iceland, Sri Lanka, Romania, etc. 28, majority are the subjective ones. Important ones being UK, Dubai, Malaysia, Luxembourg, Thailand. These are treaties where you have subjective, where they look at the primary purpose test alone and they don't give any fixed numbers. US is the only treaty which is only objective. So it doesn't have a PPT clause, it only has an objective LOB. You comply with this and you get benefit of the treaty. So this is the 40 LOBs which India has, 11, 28 and 1. GAR is coming in 25 days, and what are we doing for that when we look at it compared to the LOB and the treaty network? Here, just jog back to the Shom committee report which was issued when original GAR was to come out. It was very easy to understand and very clear guidelines on what to do. It said LOB is a specific anti-avoidance, or SAR, whereas GAR is general. And specific always overrides general, which is one of the principles of interpretation. Hence, LOB will override GAR, comply with SAR and not with GAR, till Circular 789 rules, that is, benefit will be available on the basis of a TRC. GAR cannot examine the genuineness of the residency claim of a non-resident, go by the TRC alone. And the last line was very interesting. If in spite of a limitation of benefit clause, like is the case in Mauritius and Singapore, there is evidence of violation of treaty, even then you cannot invoke GAR, the only recourse would be to go back for a renegotiation of the treaty. There are very clear-cut guidelines that GAR will not apply when you have an LOB, nothing to look at, just follow the LOB. If there is yet violation, go back for a treaty renegotiation. Now, CBDT has come out with FAQs, where it looks at that when GAR will be applied, even if there is a limitation of benefit clause. Now, what the FAQs say, that adoption of anti-abuse measures in the treaty may not be sufficient to address all forms of tax avoidance, and GAR is required for the same. If avoidance is sufficiently addressed by LOB, no occasion for GAR. Now, what is the meaning of sufficiently addressed, and what is the meaning of sufficient addressing of tax avoidance? So again, we are going back to subjective criteria of what is sufficient, what is not, and you don't have a clear-cut guideline. In spite of complying with the LOB, you may be hauled up by saying you have not sufficiently addressed tax avoidance and hence you will not get benefit of the treaty. So this is something which the CBDT's FAQs, which came out in January, have said, and it's quite in contrary to what we had expected based on the earlier Shom committee report. What if the intermediate holding company or the foreign portfolio investor or the special purpose vehicle is set up in a tax-friendly jurisdiction? In such a case, would GAR apply? Is what again the FAQs ask. Here, again, not a very clear answer. Depends upon the main purpose of choice. What is the main purpose of going to Mauritius or Netherlands? if the jurisdiction is based on non-tax commercial consideration and main objective not to obtain tax benefit, GAR would not apply. So again, these are words which are very heavy to use, but it's very difficult to understand how they would apply in a particular case. So that means mere compliance with the limitation of benefit clause not entirely enough. Main purpose and commercial non-tax consideration would have to be examined to consider whether to give treaty benefit to an IHC or an SPV or an FPI set up in Netherlands or Singapore or Cyprus. Just as we looked at grandfathering under the treaty for corporate actions, what about grandfathering for GAR? Now the rule 10U provides that GAR will not apply to any investment made prior to 1st April 2017. What happens to corporate actions and conversion of investments arising after 1st April 2017? Well, the original shares were bought before. So say bonus shares issued after April, stock split taking place after April, CCD conversion after April, CCPS conversion after April, all cases original before April. Here the CBDT FAQ says grandfathering is available from 1st April 2017 for investments made in the past. Same logic will apply even to the new shares arising on bonus, stock split, CCD conversion, CCPS conversion. I believe this CBDT FAQs can also be used for support under the treaty grandfathering provisions which we looked at, and the same benefit should therefore be argued that when you are giving it for GAR, also give it for the treaty network. So we are trying to draw an analogy between GAR grandfathering and treaty benefit grandfathering. Interplay between LOB and GAR under the Fantastic Four treaties. So LOB for shares bought before 1st April 2017. So I've been given a love letter by the organizer saying please conclude. So I'm just going to quickly wrap through in 4 minutes. No LOB in Mauritius for first phase, LOB in Singapore for first phase, no LOB in Cyprus at all. Netherlands, there is no LOB. GAR for shares bought before, so there is an LOB in case of the second phase in Mauritius, there is an LOB for the second phase in Singapore, and there is no LOB in Cyprus. Third phase, yes, we don't need an LOB because that is not under the purview, and we've looked at that. Now, this is interesting. GAR for shares bought after 1st April but sold before 31st March. So here you have a limitation of benefit clause under the transitional provision in Mauritius. But you may also have GAR if the LOB does not address tax avoidance sufficient. You may also have GAR in Singapore if the LOB does not address tax avoidance sufficient. And you will definitely have GAR in Cyprus and Netherlands because you don't have an LOB. Express GAR override only in Singapore, not in any other jurisdiction. Just want to conclude by this, impact of all of this on foreign portfolio investors, FPIs or FIIs, as you see on CNBC's FIIs bought and sold shares. What is the benefit or problems to them? For them, capital income from sale of shares is always treated as capital gains because of an amendment to section 2, that gains made by an FPI will always be capital gains. So no question of business or capital gains. You don't need to look at quantum, frequency, source. Eligible for DTA benefits in all 4 nations subject to the conditions, grandfathering available, no limitation of benefit for investments prior to 1st April, no MAT because of the amendment to the 115JB, and the Finance Bill 2017 now provides indirect transfer rules not applicable for FPI category 1 or FPI category 2. So this is a great benefit which is now being given to FPIs. So they are more or less on a super wicket because they have been given MAT exemption, indirect transfer exemption, and their income is always capital gains. If you are an FDI investor, a private equity or a venture capital fund, you do have the problem of capital gains versus business income. Here, very important, if the assessing officer treats your income as business income, treaty benefit will not be available. Forget the grandfathering provisions. They will say this is business income, look at Article 7, read with Article 5, and they will check whether you have a PE and it will be treated as business income, no question of grandfathering. If control and management is also transferred, the CBDT came out with a circular in May 2016, unlisted shares would be treated as capital gains. But where control and management is sold, it may be treated as business income. So when a private equity sells control and management, like in the case of Alliance Tires, KKR selling it to Yokohama, 90% stake with control and management, it may be treated as business income, in which case treaty benefits will not be available. GAR benefit available, no MAT. Here there is no exemption for indirect transfer. So if you are coming from a non-treaty jurisdiction, you could have a problem when it comes, because you don't have an exemption under the Finance Bill 2017. Last slide, should we all go orange? Should we migrate to Netherlands? That's the question which I would like to leave you with. Tax in Netherlands only if 10% held in Indian company or 10% or more sold to non-resident Indian. FPI anyway cannot hold more than 10% under SEBI regulation. No limitation of benefit clause in the treaty. Would migration attract GAR? Now, this is something which I would like to leave you all with as a parting thought. I'm in Singapore, I want benefit and I migrate to Netherlands. Would I be hit by GAR? Here CBDT says no GAR if jurisdiction choice based on non-tax commercial considerations and main objective not to obtain tax benefits. So if you can show both of these, you may consider migrating or even consider going to Spain or France and look at the tax benefits available under that. Thank you very much, friends, for a patient hearing. I'm glad to answer.
Thank you, Anup. May I request Kishore Padke to give the concluding remarks and also propose very well-deserved vote of thanks for this technical session.
Friends, on behalf of all of you, I must say we are totally mesmerized, Anup. It was a brilliant speech, it was a brilliant analysis. Look at the topic you just started with. So the topic given was the amendments with respect to the 4 treaties. And Anup has very aptly taken out the absolutely right point in the treaties, which grants the maximum benefit when the treaty comes into the play, which is capital gains. And he has absolutely analyzed it thoroughly. He has compared treaties with treaties. He has compared the prior position of a treaty and the post position after the amendment. Within the treaty also, within the capital gain chapter also, he has analyzed, he has tried to make differentiations between the shares per se, the preference shares and the other properties. Absolutely brilliant, friends. We are absolutely mesmerized. He has of course made reference to various judgments and tried to settle them with respect to what was the real thinking process of the judiciaries and how the judgments have evolved. Friends will observe that from Azadi Bachao, the T. Rajkumar, very brilliant judgment it was actually. The various judgments have been there was a tussle between the moral aspects vis-a-vis the economic aspects, in the sense that let's understand the tussle actually. The tussle is that all these investors really do not pay the capital gains tax when the shares are sold of a company which is in India. The whole argument is that, look, after all, a resident in India always pays the tax, and how a non-resident doesn't pay the tax? After a non-resident, when he is getting some source from India, the company is in India, the entire business is in India, he should pay some tax in India, because after all, there is some infrastructure which is being used actively or passively. The other people are paying the tax. So how come you are not paying tax? So it's a morality, basically. As it is that the investors have been saying that, look, this is the position of law, this is the position of treaty, these are specific wording, and courts have been leaning towards the wording per se. They say that law has to be clear, law has to be absolute, and if there is no provision granting you a benefit, granting, let's say, limiting you a benefit, then the benefit ought to be granted, which emerges from the wording. Now, as analyzed by the wordings are changing, the GAR is coming, and now the wording which was trying to protect through the treaties, now it has started becoming more correlative towards the non-granting of a benefit or non-granting of a protection through the GAR. So now the same wording is going to be used against the investors. We'll have to wait and watch how the investors really respond to all this and really whether the investments get impaired. We trust, we hope that now since the GAR provisions are well made aware of and why it is followed, it's one of the BEPS plans also. So they should be well accepted by the investors, and we should be able to rest with that, and the FDI flows will continue as they are right now, despite the GAR provisions being there. Of course, we'll have to remember that, as Anup has very rightly analyzed that slide number 9, we must take it actually as a very great point as to how to analyze the treaties. The LOB clause and the various within the LOB, the various dimensions of that given in that slide number 9, which really impressed. Actually, that data is that you will have to really compare one LOB clause with another LOB clause, or the situation to situation. So what solution could be for a country A might not be for a country B, and so on and so forth. Friends, really a great learning for all of us, and we are absolutely thankful to Anup for for taking a great effort for all of us. Thank you, Anup. Thank you very much.